Hello and welcome to Smaulgld's update on top foreign holders of United States debt. We're going to go through the top foreign holders of U.S. debt, and just to start with, foreigners hold a significant portion of U.S. Treasury bonds that have been issued, especially over the last 30 years, and the Fed itself also holds a large number in dollar notional amount of U.S. Treasury securities. So the question is, what happens when foreigners reduce their need for US dollars and their appetite for US Treasuries? And what if the Fed is not interested in expanding its balance sheet and buying those Treasury securities? This is an issue. I've been following the top holders of the US and keeping a blog post updated since early 2014. This is the first podcast I've done on it, and things have changed since then. The question at the time was, what happens if foreigners reduce their need for US dollars and treasuries, has turned into, well, they have started, especially in the last 6 months, to exercise their discretion in getting rid of US Treasury securities. So what does that mean? Well, first we're going to go through some of the stories over the past few years, and then we'll go through who owns what, and who owned what a year ago, 2 years ago, 3 years ago, and what they own now, and then what the potential consequences are of the dropping in the demand for U.S. Treasury securities, how that impacts interest rates, how that impacts the U.S. economy, and inflation as well. Also, a new twist is, how does Trump play into it and his economic policies that include tariffs, tax cuts, and so on. So we'll see later on, after we go through the current state of play, a quick analysis on how all this might turn out. And it doesn't necessarily mean dollar collapse, but it may necessarily mean some type of either inflation, it doesn't have to be hyperinflation, or some type of default. And we'll see, we'll go through those two scenarios as well. Okay, so we asked the question a few years ago, what happens when foreigners reduce their need for US dollars? Now remember, the United States funds a good portion of the government by tax receipts, and the amount that tax receipts don't cover, they have to borrow. Where do they borrow? Well, they borrow from the markets, but a lot of the market is made up of foreign buyers. And dumping of Treasury securities increased last year. As you see the headline here, June 2016, foreign U.S. Treasury bond dumping most since 1978. May 2016, U.S. Treasury breaks out Treasury bond holdings of Gulf state nations for the first time. Then you started seeing how much Saudi Arabia had. And then also a month earlier, in April 2016, Saudi Arabia threatens to sell U.S. Treasury holdings if U.S. passes 9/11 bill. Saudi Arabia, for those that remember, recall, is important because of the petrodollar. There's a link here as to why Saudi Arabia matters. I go through the whole origin of the petrodollar. Saudi Arabia is not important because it owns a lot of Treasury securities. It's important because it prices and sells its oil in dollars, which means that countries who want to buy oil from OPEC and from Saudi Arabia need to have dollars in order to pay Saudi Arabia. And then, of course, they hold those dollars in the form of treasuries, often as a form of reserves on their balance sheet. We also see in September 2016, Chinese holdings of U.S. Treasuries fall to lowest level since 2013. That number, as of December 2016, is even lower than that headline there. So I update the chart from the Treasury Department. By the way, if you're interested in why Saudi Arabia matters, you can go to the website. I'll put a link below, and you can check out that story. So here is the current state of play of the major foreign holdings of Treasury securities put out by the United States Treasury Department. It's on about a 2-month delay. So the most recent one is December 2016, and you can see a decline. You can't see it here. You go to the website, you can see it. I'll give you some of my own homemade charts that you can see things better. So quickly, why foreign nations hold U.S. Treasuries? Well, that's because the dollar is the world reserve currency, And if you're going to use dollars to in international trade, you're going to hold a lot of your dollar currency reserves also in treasury bonds and get a little interest on them. Now, the United States is, as a result of being able to have the world's reserve currency since 1944 through 1971, the United States was on the gold standard. Foreign central banks could bring their dollars to the treasury and get gold, so the dollar was as good as gold, at least for foreign central banks that were signatories to the Bretton Woods Agreement. Well, that went away in 1971 when Nixon took the United States off the gold standard, and they, within a couple of years, instituted what's called the petrodollar, where dollar demand was created not because it was backed by gold, but because you kind of had to have dollars, because the United States forced other countries via Saudi Arabia to continue to accumulate dollars and use dollars because they needed it to buy oil. And also, there was, besides the force issue, there had already been massive amounts of reserves held in dollars created by the Reserve Currency Act. Well, it wasn't called that, but the Bretton Woods Agreements of 1944. So the world was already using a lot of dollars. They were unhappy that they could no longer get gold, but in a sense, what were they going to do? And now there was this newer kind of incentive or impediment, however you want to look at it, where they had to have dollars anyway in order to buy oil. And that kind of all went along fine. Despite the grumbling, foreign countries were happy to use dollars. Everybody else had dollars. It's kind of a self-perpetuating cycle where everybody has dollars, everybody wants dollars, so everyone has dollars. And it wasn't until the financial crisis, 2008-2009, when the United States U.S. Federal Reserve decided it was just going to print or try to print its way out of the financial crisis and basically buy U.S. Treasury securities for free, basically, because they would print the money, and then as the U.S. issued their Treasury bonds, the newest ones, the Fed would buy 50, 60, 70, 80, 90% of the newly issued Treasury bonds, and that kind of annoyed the countries that had built up Treasury bond positions because it undermined the value of the treasuries they held that they had worked hard for, traded a lot with the United States in order to accumulate. And so it was driving it was like extra demand, like somebody was in the market, i.e. the Fed, buying bonds and creating demand for it and driving the yields on them down. And starting in 2013, this is probably why the U.S. finally finished its last QE program. China called for the world to de-Americanize, quote, because the destinies of others are in the hands of a hypocritical nation and have to be terminated. So they felt that it didn't make sense to continue to use dollars if monetary policy could be such where they could just print, self-deal in a sense, their own bonds. And there was a series of de-dollarization initiatives put forth by China. We've covered this one in the past too, but I'll put a link to it, where China worked on creating, in some respects, an alternative system to the US dollar, while also participating in the IMF and eventually getting itself, the yuan, included in the IMF's creation, which is run by the United States, or created at the same time as Bretton Woods, into the SDR. And what China was doing was setting up alternative payment systems. I'll also leave a link here. You can see the different Chinese de-dollarization initiatives, the Asian Infrastructure Bank, the Chinese International Payment System, the creation of yuan clearing banks, creation of yuan swap facilities, selling of U.S. Treasury bonds, and so on. And other countries were also in the process of de-dollarization, including Russia. Now, Russia didn't have as much trade with the United States, never really did. So they, in a sense, were more than, it was no skin off their nose not to have as many U.S. Treasuries. It was no problem, not because they're not really trading with the United States. They could sell their oil however they wish and take whatever payment they wish. And they became a trading partner with China. They sell a lot of oil to China. They sell gold to China. So I'm not saying they're China's little brother, but they are in more of a position to de-dollarize than China is, because China conducts lots of trade with the U.S. and lots of the rest of the world who are also trading with the United States. So during the period of time from 2013 to 2016, China began to, not only these de-dollarization initiatives, began to sell off its treasury securities. And the fear is that if foreigners sell off their treasury securities, who's going to buy them? How's the United States going to continue to fund its deficit spending? Well, there's a couple of things. Is that the deficit spending can increase, but you say, well, how does it increase unless somebody buys them? And the traditional buyer has been the Fed, or the other countries, the foreign countries could buy them. Now, if they can't find buyers there, they can also have U.S. buyers. They can put it. So obviously, if you raise interest rates, you're in a sense putting treasuries on sale. And the fact that all the other central banks don't pay interest, have negative interest rates, that does make them more attractive, even though during the time period where the Fed has been raising interest rates and yields on U.S. Treasury bonds have gone up, the demand really hasn't increased for the foreigners. But that could change. But let's go to now China's Treasury holdings. Even while China was making noises in 2012, 13, 14 about the amount of what they thought was monetary abuse coming out of the Federal Reserve, they really didn't sell many treasury bonds. It was more a lot of setting up of the system. But if you look here, January 2014 through January 2016, they sold 30-40 billion dollars out of their 1.3 trillion dollars worth of treasuries. That's not much. But over the past 6 months of 2016, boom, they have gone down a lot. They're almost down to $1 trillion. Now, part and parcel of those sales, the Chinese overall reserve position has gone, I don't have a chart here, but it's gone from like 4 trillion to under 3 trillion. So they have been selling off their reserves, and basically they're doing that to protect the yuan, which is a bit weak. It has been weak. Now you say, well, the Chinese like to have a weak yuan, but not to the point where it's going down too much. So in any event, China has been reducing its treasury holdings, reducing its overall foreign reserves, while somewhat increasing its gold reserves, but not at a rapid pace, at least not at the People's Bank of China. That's a separate issue, how much gold China has. There's plenty of gold in China, plenty of gold still going into China, through Shanghai, through Hong Kong, plenty of gold being mined, not leaving the country, but it's not just finding its way onto the People's Bank of China's balance sheet. So Chinese treasury holdings are down 17% since 2014, and really about the same since the 2015 and 2016. So selling of Chinese holdings of U.S. treasuries has really started to accelerate. And they no longer, I believe, are the number one holder of treasuries. I think Japan, yes, Japan has now passed them since November and December. Japan also holds over $1 trillion of U.S. treasuries. Now let's take a look at Russia. Now Russia, a lot of people talk about, well, Russia is adding gold a lot, and they are the number one. They've added more gold than any central bank in the world over the last 3 years. They had over 200 tons in 2015, 199 tons in 2016. They opened up 2017 with 31 tons or a million ounces. So they are continuing to, and that's mostly from their own gold production. Russia is the second or third largest gold mining country. They basically add 60, 70, 80% of their annual mining production to reserves at the Central Bank of Russia, and then they ship off the rest probably to China. Now, Russia historically, well, first of all, Russia is a smaller economy, so its overall reserves are $300, $400, $500 billion, so they're not as great as China historically, but they've also not held as many T-bonds. Why? They don't have to buy oil from Saudi Arabia. They actually produce more oil than Saudi Arabia, and they sell more oil to China than Saudi Arabia does. And they don't trade with the U.S., and the United States put sanctions on them the past few years. So there's really no need for Russia to hold excess amounts of U.S. treasuries, other than it's good, prudent in the world to have treasury securities because they're liquid and they're considered safe. So Russia has them, but never really has to have that many of them. So over the past few years, especially during the sanctions period of the last 2 years, they've actually increased their overall reserves while decreasing their U.S. Treasury securities, you can see from this chart, and adding a lot of gold. So they're just basically substituting a lot of their U.S. Treasury holdings for gold. Makes total sense. They still have a healthy position in U.S. Treasuries. And in fact, when they add, they need to be diversified. And when they add to their reserves, sometimes they add back U.S. Treasury. So basically in early 2015 is when they had their lowest point of U.S. Treasuries. It went from 131 million at the beginning of 2014 to 66 billion in early 2015. But since then, you can see they've rebuilt their U.S. Treasury position, but they've also, and we'll see, I think I have the chart below. No, I don't have the chart below of Russian additions of gold to the reserve, but you can always check that out at Smaulgld if you're interested. I cover it monthly. You go here to gold, you go to gold reserve by country, click on Russian gold. You'll see every month of China and Russia's gold additions to their reserves. On this particular blog post and this podcast, I don't show that. Okay, so they're down 35%. They've shed 35% of their reserves, but really 86 billion, what's that, 1 month of QE? They don't have that much. So if Russia decided tomorrow that we're going to sell all their treasury securities, and they wouldn't do it all in one day, and they're never going to buy them again, it's not a big deal. Why? Well, if you look at the list, Russia is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. They're like number 19, 17, 18, 19, 20 in the overall scheme of things. And they have less than, China has 10, 11 times more than they do. So does Japan. So it's not a big deal if Russia gets rid of their treasury securities. It's more of a big deal if China continues, and I'm not sure if they're going to continue to get rid of their treasuries at the same pace that they have been getting rid of, but we'll have to see. And we're going to get to what it all means if they do continue to sell. There's also the story of Belgium. I'm not going to get into the complete tale here, but Belgium is not really, if you look here, I'll just go straight to the chart without the verbiage. There's no way a country the size of Belgium would ever need to own $381 billion. I mean, it's dwarfs the size of the country's GDP. Why would they have that many? Well, it doesn't dwarf it, but it's unrealistic for a country to have this many treasury securities. So this isn't, just a quick note on what these, when the U.S. Treasury Department says foreign holdings of treasury securities by country, it's not necessarily the country that's holding them. It's nationalities that hold them. So you assume that the bulk of these are held by the country, but in this case, Belgium could just be a proxy for example, Chinese holding. They buy them through clearinghouse that's in Belgium. So it's not the Belgian government that holds. There's no way the Belgian government holds this many. There's no way Belgian citizens had held this many. And you could see the decline in Belgian holdings of treasury securities kind of mirrors. It looks like they started, China, if you believe that, it's possible if China had bought through Belgian entity, that they started selling their Belgian treasury securities first, and then recently they've been selling their own that they held on their own account at the People's Bank of China. So it looks like Belgium is no longer, and it was kind of shocking. I don't have the chart before this, but they were down here, and the next thing you know, they had increased their treasury securities a pretty substantial amount, and they've decreased them a pretty substantial amount. Now, aside from foreign holdings, the Federal Reserve holds about 2.5 trillion bonds. That's basically more than Japan and China put together. And where did they get those from? Well, the bulk of them, if you look at the chart here, the bulk of them they got after the 2008 through QE. And then basically this line here that just goes straight across. Actually, this is a more current chart here. This is a live chart. Wasn't shown before I put a link here, so this will just update. This just shows that when they stopped QE at the end of 2014, they haven't sold any, and then when they reinvest, they go up slightly. So they got all of these treasuries. They used to have 400 billion. Now they got 2.5 trillion of treasury securities. So they are the main holder of U.S. Treasuries now, even more so than Russia and China. Now, one thing that can happen if you do have an issue where you don't have a buyer, well, the Fed could start buying them again. I think the Fed is reluctant to start buying Treasuries more and relying on that because I don't know how they got away with this, but they did. I think they realized they can't get away with two more because they don't want to drive out the rest of the foreign purchases. And you saw what happened. Japan does this, and it does not help the economy. So we're going to look at what might happen now, how the economy might work. But let's just quickly look. Oh, I do have here. Here's the Chinese gold reserves in January 2017. You can see they've added gold, but not that much. And then I think I should have Russia. I do. Yeah, Russia continues to add big amounts. This is through January 2017 as well. And that there's an updated chart there too. So Russia and China are now in the top 10 of gold holding nations. All right, so what does this all mean? Well, inflation is probably the natural result of what's going to happen, and I mean price inflation. Because under Donald Trump, he's going to try to save money through hiring freezes, through cutting regulations, trying to get Europe to pay more in NATO. There'll be some savings there. But the United States is still going to run an annual deficit, it would seem. And initially, he's going to put in tax cuts, which means fewer tax revenues. However, on the plus side, tax cuts, if put in the right place and the incentives are in the right place, you could have an actual increase in tax revenue if it generates a disproportional increase in economic activity, which means people, companies make more money, and therefore, even at the lower tax rate, they pay more taxes. That's the Laffer curve. If that happens, then you may have some decline in the deficit based on the savings and the tax. Now, this is all, I'm not saying this is going to happen. I'm saying that it's possible. This is the whole grow your way out of the deficit, which I don't think I think you can grow your way out of increased deficits, but you're not going to grow your way out of $20 trillion deficit. Also, the United States will increase coal production, oil production, shale production, which means the United States should be able to export some oil, more oil, should increase their decrease the trade deficit. And then, of course, there's the idea of tariffs. Now, what are tariffs going to do? Here's where the inflation comes in. If that happens, then the United States is going to have to pay more for goods coming into the country. And some of the goods, they're not going to be able to, at least in the first year, 2, 3, 4 years, get, if ever, domestic manufacturing capabilities to a point where the United States is somewhat or less reliant, or somewhat self-sufficient or less reliant on imports, which means that the imports are more expensive, which means you have an increase in inflation. Well, in some respects, that's good for the Treasury holding position, because one of the problems with owing so much money is the cost of servicing is increased, and it's hard to pay back even the interest. Now, you can keep piling on. That's how a Ponzi scheme works. You pay the interest by issuing more treasuries, and then with the new money you get in, you can continue to pay the interest. But eventually, that gets unsustainable, and it sounds like Trump's Treasury Secretary and Trump are not interested in piling on the deficit. Now, Reagan wasn't either, and he did. So who knows? Every president has added to the deficit. So even in the best case scenario, if the deficit stays the same, it's still an unsustainable path. And most likely, the things that Trump will do to try to jumpstart the economy are going to be inflationary. And that may be, and it doesn't have to be hyperinflation, and it doesn't have to collapse the dollar, but what it could in effect do is lower the dollar in value, increase inflation, because if the dollar is worth less internationally, not only do you have tariffs making the goods more expensive, but the dollar isn't going to go as far to pay for the imports, so you're going to get inflation. And that doesn't have to be hyperinflation, but it could be upper single digits, tempered double digits. And in a way, that's how the United States can afford to pay the interest. Now, if it's done properly, and when I say properly, it could be done via a growth period. You would have this increased GDP, you would have increased cash in people's pockets because of tax cuts, and at the same time, they'd be paying more for their goods and services that were imported. And also, you would have perhaps more people working, more people making more money. But overall, you'd be getting this counter positive, which would be the inflation. Now, again, if it's done correctly, so to speak, you may have a period where things are not good or kind of good because the inflation is kind of destroying whatever progress there is. But inflation can be transitory. It can last for a period of years. And that may be the period of time where the United States works its way out of these issues by having a period of sustained inflation. If that's the case, the dollar doesn't have to collapse. It just has to fall a lot. And because of the inflation and because of the liquidity of the dollar market and because interest rates will be higher and probably be higher than most of the other sovereign entities, you may see a re-increase, increase in demand for U.S. Treasuries. I think that's more likely than a outright default where the United States says, look, we just can't pay. We're going to pay X amount on the dollar. That would probably undermine and create even more inflation, undermine the dollar, at least initially, and undermine the dollar's value. Although that scenario might eventually be the best thing, because if the U.S. gets away with that, then it would be probably after a while become a better credit risk because it owes less money. In any event, it's just something to watch. There's just not one answer that when foreigners stop buying U.S. Treasuries, the dollar collapses, the United States collapses. Not necessarily. And no one knows the answer to this. I don't know the answer to this. I try to analyze this. I'm not making predictions, but I'm somewhat amused by many of the commentators who insist they know this is what's going to happen. The same people who insist that COMEX is going to default next week, defaulted in 2012, will default next week in 2013. It doesn't happen, and there's a reason it doesn't happen. They don't necessarily know. I don't necessarily know. So all I advise you to do is to take a look, see what you think, look what's happened in the past, and then keep in mind just what's happened in the past is instructive to what might happen in the future, but it's not a guarantee. In any event, thanks for listening, and we'll talk to you soon.